Welcome to a new episode of In the Money with Amber Kanwar. Today on the show, I've got Kelsey Dunwoodie, a portfolio manager at Deans Knight Capital Management. They're based in Vancouver, but she joined me here in studio, and she has a really interesting bent. She looks at small cap, mid cap, Canadian natural resource stocks. I'm talking energy, I'm talking mining, I'm talking uranium, and everything in between. What I love about this is, she talks about entrepreneurs. And I think when people look at that in the United States, they think about, your tech guys like Mark Zuckerberg. She says our entrepreneurs as Canadians are in the mining space, are in the natural resource space, and that's where she finds her alpha. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. Before we get started, a message from our sponsor, Raymond James Limited. For 25 years, Raymond James has been helping Canadians achieve their financial goals with confidence. As Canada's largest independent financial services firm, they manage over $95 billion in assets and support more than 520 advisors nationwide. What sets Raymond James apart is their commitment to independence. With no proprietary product to promote, their advisors are free to focus solely on what's best for each client, whether that's planning for retirement, funding a child's education, or preserving wealth for future generations. To learn more about how Raymond James can help you live a life well planned, visit raymondjames.ca. Kelsey Dunwoodie, thank you so much for joining me on the podcast.
Thanks for having me.
This is our first interview together, the first time that we've spoken. And I know mining is all about unearthing things. I feel like I've unearthed a woman in mining. How incredible.
Yeah, it's a rare territory, I guess, at the moment, or maybe increasing, hopefully. People are getting more interested.
How did you find yourself in this specialty?
Well, it's a long story and I'll try to keep it short, but in essence, I work at a private manager, Deans Knight Capital Management. We're based in Vancouver and we're generalists, but for 30 years, we've always found value in resources, energy, mining. So we've been invested in various companies and I built my appreciation of the resource sector there. And then over the years, just being on the West Coast, a little bit of a mining hub, and struck up a partnership with a local engineering and project management firm called JDS Resources. And together we started a resource-specific strategy in 2020. So
kind of new-ish, but as you mentioned, this has been kind of a flirtation of Deans Knight getting into the resource space. What is it about this sector that you love? Because you're a generalist, I've confessed many times, I don't love commodities. They're so cyclical, and I just don't know what are the prices going to do. And it's so much seems out of these companies' control. What's the counter to that?
Well, yeah, I don't try to predict any commodity prices. I think that's hard for anybody to do. What we think is there's just really great businesses in resources. I personally love it because, we don't really have a Silicon Valley in Canada. And, we have a really strong preference to entrepreneurial or founder-led businesses at Deans Knight. And in Canada, those are resource businesses. I mean, we do have other industries that have, family. Obviously, we have lots of sort of dual share structure companies around Canada. But really, when you can think of like a young person, maybe not even a young person, but let's just use that as a theory, going out after school, shooting some seismic or doing some drilling. And then before you know it, they have a resource that's developed into a mine that can employ hundreds. I mean,
is that
I just
how it
think
happens?
It's incredibly, that is how it happens. I mean, not every opportunity. So you have to, be shrewd. But I just think it's a really great story. And in Canada, we should be taking advantage of what our assets are. And our assets are really natural resources.
Somebody should make a movie about that. Like our Silicon Valley is like these kids going out after school and doing stuff like that. That also kind of tells us a little bit about your investing style. You're not looking at the Newmonts of the world. You are looking at kind of the smaller cap opportunities. What does that filter look like? What is the range of investments in terms of size that you're looking at these days?
Yeah, I mean, we have an advantage that we aren't really limited by a low market cap at the moment. What I would say, though, is there's an incredible amount of opportunities still in like medium to small cap producer developers. And I still represent to my clients or our clients that these are businesses. So it's going to be rare to see us get involved in like a very early, we're just putting drill holes in the ground type opportunity. Mm-hmm. We like to have a little bit more structure to it, and we still can find a lot of value, in a sort of getting into the final investment decision or developing, and of course, producers.
So much of this, it sounds like, is a relationship business too. Like you have to know who's out there, who's got the track record. Talk to me about that part of the business and why maybe it has a greater emphasis in your kind of corner of the market.
Yeah, I just think I've always been trained at Dean's Knight is that it's all about people. And I'm not going to get the quote right, but it's like, you should buy a business that a fool can run because someday they will. Like, hopefully that's not going to happen. But, in resources, it really is about people and obviously the quality of the asset. And we think about that for every business. But our sort of edge or what we want to be able to do is say, I need to find out something about the company. I can call the CEO. I'm never going to be able to call the CEO of Newmont. So, that's not interesting to me. And it's not because we're looking for inside information, but you can only put so much in a press release or an investor presentation. And these businesses are so layered. We really believe you need to be able to have that dialogue.
You can call a CEO or they can call you. I want you to tell the story you just told me about a time you took a call while you were at Disney. That's how you want to know how dedicated she is as a money manager. Yeah. What happened?
So Amber shared that she's going to take her family to Disney, which is truly a fun experience. And this is quite a while ago, and this is actually pre-COVID. So I had no idea how to use any sort of technology. So it was really just like a dial-up on a cell phone. And yes, I was at Disney, and somebody who was overseas needed to talk to me. And, we don't own Disney. It's not in our portfolio. But I would say, great customer service. I had to go to guest services. They never had anybody ask, or at least the people there today, to do a business call in a quiet place at Disneyland. But they found me a post office at Main Street, USA. And I took a conference call there while everybody was, peering in the windows. So.
And the client had no idea. They just think you're busy working. That's dedication, folks. Okay, so we've learned about you. We've learned about your approach. Now let's talk about these markets. I know you said you try not to buy businesses for the price of the commodity, but it's hard to ignore the price of gold right now. Talk to me about this tremendous rally that we've seen in gold. And now people are using words like meme and bubble, not to describe AI, but to describe the gold rally.
Yeah, like I am not going to predict the price of gold. And if I could predict it, I would have put the whole portfolio in gold a year ago. We do have a healthy position, and it's obviously been really positive for our shareholders this year. For us, we're always looking at what can the business do with the cash flow, and also on the downside, what is their protection? So in these businesses, what's their marginal cost they're going to start losing money, and all these businesses, especially the producers today. There is a very large delta between today's price and what their cost is. And so what that means is they're just accruing so much cash onto the balance sheet right now. And like a lot of resource businesses that were really out of favor in the past decade, they're not anxious to spend the money. They're being very disciplined. And many of them they're what I like to call survivors. So if they were here 10 years ago and they're here today, they've been through some tough times. But they've also, if they've had production and they've had cash flow, it's been, lower cash flow at lower commodity prices, but they've been able to accumulate some cheap assets in their portfolio. So a lot of the companies maybe we meet with, they're not, if they see an opportunity in M&A, they'll take it, but they actually have a lot of things within their portfolio that they can pursue right now. So, what is gold going to do? I don't know, but I think, the companies that I own and some, companies that I don't own, they still have a lot of opportunity within their balance sheet. And right now they can just accumulate cash, a war chest, if you want to call it, so that they are not going to be dependent on issuing stock or going for debt when they want to take their next step in the business.
Sometimes, though, a business can do well and the stock won't. And so I'd like you to tell me, there's a lot of people that are probably sitting on a nice gold gain. And then they saw in October, my goodness, the miners pulled back by 13%. The junior miners pulled back by 17%. Gold didn't pull off as much, but clearly there was a little bit of nerves about the pullback that we saw in gold. So how do you reconcile the fact that it sounds like you think the businesses are going to remain healthy with what we might see in the stock market?
Yeah, I have a really long-term view, so I don't pay attention necessarily to those short-term. I know it can be emotionally really difficult. I think as an investor, which I'm going to separate from being a trader, is you need to look through those types of changes. And people always say, oh, it's commodities are so volatile. And, you're saying 13% drop. But, I'm not an expert in the NASDAQ, but I'm pretty sure all of the Magnificent Seven dropped more than that, in the past 12 months at certain points. So, stock prices can do that. And sometimes when something's been on such a run, I guess, you do have investors that aren't invested in it. They're really traders. And that type of commodity event might just make them nervous and make them sell and say, I'm going to take my profits now before, they go even lower. But
I'm trying to remember what year it was that gold imploded in a week. Do you remember? I think it was 2011? That sticks out in my mind. I'm going to look it up, but the reason I'm asking is people were having that conversation again. All of a sudden it was well, what is our conviction in gold? Why are we buying it? Mm-hmm. What's your answer to why are people buying it? Because it seems to be decoupling from some of the maybe historical reasons that you buy it. Inflation it's elevated, but it's coming down.
Yeah. Again, I can't speak for every investor. I guess when you read the newspapers or listen to people like yourself, Amber, there's a lot of speculation, I guess, in gold regarding some of the, security of other investments. So, the argument maybe people are investing or governments are investing in gold over US treasuries, or people are nervous about, increasing debts around the world. And so it's an inflation position. But for people like myself who are looking to buy good businesses, we obviously are a benefitter of the rise in the price of gold. But I don't think that we're purchasing it because I have a view on the, risk of a U.S. Treasury. I do read things that are, the historical allocation to gold in portfolios is still quite a bit lower than where it's been. So if you believe that, things revert to the mean, then there's still a fair bit of future demand for people to put some of their portfolio into gold. But I do think it can get confused between people buying the hard asset and people buying, gold miners. Because obviously with the miners, you get the production risk, but you also get the, increased leverage as they increase production or increase margin. So they should outperform the price of gold if it's rising and doing well.
I think it was 2013. I looked it up. Then we had that kind of ugly spike down. And yeah, kind of sentiment got cloudy and ugly. You've come to this point a bunch of times where you've tapped the fact that the businesses this time are maybe different than they were back then, right? When there was kind of a growth at any cost sort of mentality. They remember how painful that was, not just for shareholders, but also for their jobs, right? Mm-hmm. All those executives are basically gone. What do you think this new wave of M&A could look like? We are seeing some consolidation this week. Core Mining purchasing New Gold. immediately making another new senior gold miner with exposure to North America with that deal?
Yeah, I think I have a couple comments on M&A. For somebody who looks at really like smaller or medium cap companies, sometimes M&A makes me a bit nervous not from the perspective of someone doing the correct deal, but just in terms of all of these industries. Like we've seen it in energy, that bigger is better. And, it is eventually the law of large numbers. If you're bigger, you're not going to grow at the same rate, right? A smaller company can grow at a higher rate than a bigger company. And also, I think the way the ecosystem works is that you have a good number of healthy large companies, and then you have a larger number of growing small companies. Because, there are, especially in gold, like gold is a great example because you can have a very profitable 100,000 a year gold mine. It's harder to do that in a lot of other commodities. You do need bigger scale. So we should have a good, healthy market of juniors, which we still have in gold. But as M&A goes on, we'll have to see what happens. I think one thing that does happen that's interesting is some of the assets in these big companies can get stranded. And then that's an opportunity for either management within the company to say, hey, I like this asset. Can I, take it outside, start a new company? That happens sometimes. Or else, of course, divestitures to other companies. So
you're not buying these small and mid-cap miners thinking this will be a nice fit for Newmont or Barrick?
I don't buy them with that in mind. I mean, we obviously want a value creation.
Yeah.
I'm looking for them to produce value, through cash flow. But yes, you can see that some of them, and that some of them, the team that's maybe developing it is not the team that's going to operate it. But, I like to go by the theory that the stock market could close tomorrow. And is this business going to be viable? And if your only exit is M&A, then that's not the right outcome. So it's not how we invest, but it does turn out that over time, a lot of our, sell methodology has been to take outs.
You mentioned that this applies to the energy sector as well. You've got a big chunk of your portfolio in mining, but you've also got some in the energy sector right now. Does it skew more towards oil producers, gas producers? Help us understand that picture.
Yeah, I think not by design, but I think it's probably almost even. I like both oil and gas, and we can talk about that at some point. But as you probably appreciate, being, a lot of years covering the stock market in Canada, it's very hard to find like a pure play in and especially in Canada, we have a lot of what's called liquids rich gas. So, you had Mike Rose on the show. Mike Rose is a CEO that, we have invested with through, not myself personally, because I wasn't there through all these iterations. I only started at Deans Knight in 2010. But, before Tourmaline, his two companies before that, my partners were involved in. It's called Tourmaline Oil, but he's the largest natural gas producer in Canada. And in that natural gas, he has a lot of oil liquids. So long answer to say it's a mix. And it's really because of the businesses we own happen to have a mix of the product, because that's where the CEOs are seeing the most value.
And I guess, does it go back to what you were saying? You're not agnostic to the gold price, but, oil prices kind of continue to languish. Natural gas, we're waiting. Winter is coming. And we're starting to see it perk up. Like, are you constructive at all on the underlying price? Or are you buying these companies like maybe a Tourmaline, for example, because they're just well managed and they can do well. They can continue to exist. Is the business viable? It is viable even when prices go negative.
Yeah, for sure. I mean, I think we were saying before we started recording, this is an optimistic business. So, I wouldn't be involved in the business if I didn't think that the price of oil or the price of gas is going to go higher over time. I don't know when. And again, not to repeat myself too many times, but I think more than any space that I'm invested in right now, energy companies, they are survivors, and they have, the good ones have had a lot of levers to pull over the, lower price environment. But I do believe with, LNG Canada, there's future LNG facilities that are going to be developed off the coast of BC. and then hopefully some, new infrastructure for oil and gas in this country, that we will have more markets to access. And, that can only be beneficial to the price. It gives optionality to the operators. And herein, when we talk about companies getting bigger, this has been a lot of the reason for consolidation in energy in Canada over the last few years, is these bigger companies have more bargaining power. They can get access into US markets. And that's what you've seen, these really high quality management teams do. So they're diversified away from just being dependent on Canadian natural gas.
Are there as many small cap opportunities for energy? No. It's like it's disappearing almost by the minute compared to mining, for example.
Yeah, for sure. I mean, this is kind of like, I wouldn't really call it a rant, but it's a little bit of a soapbox that I get on now and then when I talk with, CEOs and just other people who are invested in the space. But like everything, I think there's a cycle. I mean, this Canadian energy industry has been so handicapped for so long. It's really unfortunate, but the policy and the sentiment hit the Canadian energy CEOs and companies the hardest. And so capital goes where it's welcome. And capital has left in droves from Canada and from energy being a lot of where the capital's left. And so you can't survive as a small company. And it's unfortunate because that's how these big companies have been built over the years. But I do believe that, that will change. I am seeing some, small. They're not small compared to what I saw when I started my career. Like you could have a few thousand barrels and be a company. But today a small producer is like aiming for 25,000 barrels a day, which would be like a lot.
Mm-hmm.
But yeah, it's harder to find those small companies in energy right now.
But it's like see light, like a little bit of light coming through.
Yeah.
Small cracks.
Optimism, right?
Optimism, yeah. Toxic optimism. Yeah. We love that on this show. Before we get into the mailbag, because we have a lot of questions that I think our viewers will be interested in, I want to spend a beat on rare earths. That's all the talk right now, especially with trade negotiations between China and the US. But also, like with Canada, might be able to play a role in that, basically reducing the US's reliance on China, which supplies 70 to 80% of rare earths that power everything: TVs, electric batteries, those sort of things. There's a rare earth ETF, the VanEck Rare Earth ETF, REMX, and it's had a very nice run in 2025. But every time it seems like things calm down on the rare earth side, like they've done this week, then the stocks sell off. How do you think about rare earths and whether there's an interesting investable idea here?
Yeah. So I don't own any rare earths. And, we always say it's kind of funny because rare earths aren't that rare, which you might have heard before. But they're difficult to bring to a final product. And it's just an acumen that we haven't developed in North America. And China has developed all the processing capabilities for most of these materials. And it's not that we can't figure it out or we won't figure it out. Some aspects of it are probably not that amenable to the way that, Canadians or North Americans want things to be produced. So, we have different environmental standards. Mm-hmm. We have different timelines to get into production, lots of checks and balances. And bringing rare earths all the way to the final stage that they could be used in a battery or wherever we're going to use them, it's going to take a long time to figure out. So, we pay a lot of attention to it, but I feel like it's not where I need to risk my investors' capital right now.
I think that's an important point. Rare earths I think it's 17 compounds that are chemically similar. And to your point, they're plentiful, but getting them out, extracting them at scale, is very challenging. I think about, this gives me parallels. I know you're not a tech investor, but kind of like Taiwan Semiconductor. You can make semiconductors anywhere, but Taiwan Semiconductor has just figured out how to do it really, really well. And the gamble is like, can they export that to the US? So a lot of these people chasing the rare earth sector, maybe they're thinking it's easier than it is for like Albemarle or somebody else because that's what's in these ETFs to be able to replicate that. It's not just about where the resource is, it's the how.
Exactly.
How it's extracted.
And it's actually incredibly expensive. Like, semiconductors are, not my area of expertise, but I do think they're one of those, sectors that has been kind of volatile over the years, and it takes a huge amount of investment to make these facilities. So, these large tech companies that are now pursuing some of these businesses in their company, kind of vertical integration, I guess you'll call it. These are capital projects that they've never endeavored on. And it's not to say they're not going to be successful, but I think it's going to be challenging. It takes a little bit longer to build with a higher capital intensity than maybe programming. Like programming is primarily hiring smart people.
Yeah.
Which is very leverageable, but you can scale it up, scale it down. But once you commit to a capital project, whether it's a AI data center or something in the semiconductor space, like that's hundreds of millions of dollars, and you can't be half baked. You have to finish it. So it's going to be really interesting to see how that unfolds. An example would be lithium. We've spent a lot of time looking at it. And when we first started the fund, especially in 2020, coming out of the pandemic, everybody was super excited about green energy, anything transition. And lithium, was sort of the top of the list, I guess. But when we would spend time looking at these companies, not only do they have to develop a mine and produce a material, which in itself is a area of expertise and a challenge, they then have to secure an agreement with an off-taker, usually a battery manufacturer or some type of, subsidiary or supplier to an OEM, car manufacturers. And none of them were getting it done. And, you were looking at the size of the prize being this EV market and the size of these lithium companies, which was, pennies on the dollar to what these car and battery companies were worth. And yet the deals never came. Never came. It seemed like it was so difficult to structure a mine right to the end battery. And then, things reset in the market. People started to get a little bit less conviction on how much EVs were going to take over. So I think that that's just a sign that a lot of the insiders still couldn't figure out how you were going to get the supply chain all the way complete.
But didn't General Motors take up a stake in a lithium company?
Yeah, there's examples of things that have happened, but I think what I'm trying to say is just for every project that's out there, to expect every single lithium producer to get to the point where they're going to create anode quality material. It seems like a hurdle that we just haven't been able to achieve here in North America.
And the sector recently got a pop because the U.S. government got involved.
Yeah.
And kind of doing what is sort of unusual but is the norm in 2025. If it likes something, it goes out and buys stakes in some of these companies. And so lithium players, in exchange for loans, the government is taking a stake. Like, would you bet? People are not betting against that. People are betting, well, if it's important to the U.S., they're going to figure it out and they're going to get it done. How do you reconcile that with your skepticism about the challenge of getting it done?
I don't want to get into a political comment. I still believe in free markets. I believe in free markets. But I do think if you're trying to create whole industries, you need some pathway from the government. I don't know if share ownership in specifically choosing companies is going to prove to be the way to do it. But what I can say is if this is an objective of the government for us to bring some supply back into North America, have this know-how, then I think they do have to show investors and companies that they're going to be there to see it through. Because it's like building that first nuclear reactor. That takes a huge amount of know-how and investment and time, and it won't make you any money, on a new technology. You need to get to the next one, the third one, the fifth one before you're actually making money. And investors, they can put their capital anywhere. So I think if it really is an industry that the government wants to bring in-house, then showing some type of a signal and putting your money where your mouth is in this case is important.
All right, let's dip into the mailbag because we got a lot of questions. Our first question in the mailbag is Foran Mining. I'm considering buying Foran Mining. What do you think about the stock at these levels? This one coming from Cardi on X. Base metal producer, a lot of volatility this year, but it's pretty loved by Bay Street.
Yeah, so Foran, we don't own it. And of course, like anything we're talking about here, I can't really give advice without knowing people, and you guys understand all that. But
don't worry, we have a disclaimer that says that.
We actually did own Foran a few years ago and spent a fair bit of time with Dan and the team. So Dan's the CEO. And I think they're incredible. I have a lot of respect for them, and what they've put together and what they've done so far is amazing. And, for myself, I just rotated into a different opportunity at the time, which I still own, because Foran, it is developing. I think it's supposed to start, commercial production mid-2026. So your listener there, I think you said her name was Cardi.
Cardi, yeah.
Yeah, she will benefit if she buys it today with the fact that they're going to go into production very shortly.
This is the McKelvina Bay project that they just announced. Like they're 64% built on budget.
Yeah.
Markets like that.
Yeah. I mean, that would be my caution. And it's not about Foran specifically. I have no insights there. But any project, it's that last mile that's the hardest, And you have to manage both costs and time. And sometimes being behind time is actually worse than being ahead of the budget because, time is money, as they say. And so it's really this last mile that, can be the most challenging. But, we need more production in Canada. I love that your listeners are interested in companies like Foran. She asked about the valuation. And again, I think with a lot of these businesses, if you have a view several years out, things will compound and today's valuation. But this company's around 1x NAV, I think, price to NAV. You can buy the same company that I ended up purchasing a few years ago, which was Taseko Mines, which is also a copper producer, head office in BC. They have an operating mine in the Caribou in British Columbia, the Gibraltar mine. So it's been producing copper for years. It was producing copper when I bought it and still is. And they're bringing on a new asset in Arizona. It's actually a first of its kind. It's an in situ development. So you don't actually send anybody underground. You drill holes and you inject fluids and you bring up material and then you turn it into copper cathode. And in addition, Taseko has a bunch of undeveloped properties in their portfolio, and they're trading at 0.7x NAV. And a lot of companies are. So clearly, Foran has a premium right now. It has a lot of high quality shareholders. Fairfax owns some, Agnico Eagle. So Cardi will be invested alongside some pretty smart people. But she's going to have to wait a little bit before production is occurring there.
Okay, you like a bargain. I wonder if you see it in the lumber sector. We got a question on the lumber market and lumber stocks. It's got to be pretty close to peak bearishness, especially for companies with mostly Canadian operations. This is one coming from Bison2351 on X. Thank you for your question. I mean, I don't know. It's dangerous to pick the bottom on lumber stocks because they just keep going lower.
Mm-hmm. Yeah, I will never, they say it's time in the market versus timing the market. And for us at Dean's Knight, the time in the market has been with West Fraser Timber. That's what we own. That's what we'll continue to own. They are the largest public forest products company. They purchased Norbord. Time's got away from me, but a couple years ago now. That's Norbord produces OSB, which is more like for construction paneling.
Oriented strand board.
Yes, thank you. And West Fraser has just been excellent allocators of capital. And, if I look at a stock chart of West Fraser Timber versus, say, the forestry sub-index, which isn't very big anymore, it's continually outperformed, and it's outperformed the TSX. And it's always faced these kinds of headwinds, the same headwinds we have today. Tariffs aren't new. Environmental issues aren't new. But the challenge, what your reader said, and I don't know if they know this, but like most of our forestry companies today are not indexed to Canada. Like West Fraser makes more out of the US than Canada because these CEOs saw the writing on the wall with whether it was domestic policies that were making forestry difficult to be in or international. And they've moved a lot of production down south. So
a lot of their production then isn't penalized or affected.
Not at all.
But then you've got a sluggish housing market, what are you more optimistic on? Tariffs getting better or a housing pickup as being a catalyst for the stock?
I think somebody who's a lot closer to the forestry industry than me said, there's 25% of the American forestry demand that cannot be met in America. So, you're still going to have imports. And our softwood lumber, it's funny, it's called softwood, but it's actually harder and it's better quality. So home builders do prefer to use it for building. So it's not going away. But housing you have to be an optimist on housing. And when you look at the reports on US, it's all about US housing. I mean, Canada is a small factor. They are still building less doors, as you might say, today than they were a decade ago. And there's more and more people, there's pent up demand, I guess. And when does that switch? I mean, lower interest rates would help. Growing economy would help. So I can't tell you when, but eventually, people want to move out of their parents' basements. So that's what our view.
You mentioned they did that Norbord deal in 2020, and there are very few players left. But do you think we could see more consolidation? Like, can West Fraser nab somebody at these lows? Do we want to play a little bit of a dating game?
Yeah, I believe they can. I think the rumor, or not a rumor, I guess a suspicion would be both West Fraser and Canfor have similar shareholder bases. And Canfor has a really interesting business. They've taken a bit of a different direction and built up a supply in Europe. West Fraser hasn't really gone to Europe. They had some European operations that they acquired on the Norbord. And Europe is also an interesting market. So, what I understand is over there, it's a lot more, the way they approach growing the trees is a lot more like a manufacturing cycle. So perhaps, those two companies would fit nicely together.
Better than like an Interfor, for example, it's a bit more domestic Canadian.
Yeah, I'm not as close with Interfor. I know they've had a little bit more leverage. I mean, I'm not the CEOs. I'm not sure where they're going to want to put their next dollar. I know that, sometimes when you get a lot of overlap in your jurisdictions, then what you're going to do is close operations, right? And take capacity out. Whereas maybe it's more hopeful, going back to optimism, if you combine a company where you now just have more growth opportunities versus shutting down.
You're right. I feel like I've been hearing chatter about this as well, but I want to counsel our viewers, when you're buying a sector like this, or when you're owning West Fraser Timber, like, where is M&A in the ranking of like what you see as important or the reason you own these stocks?
Yeah, I don't own West Fraser for M&A. I mean, I own them because they're the lowest cost producer. They have and continually invest in improving the quality of their production, which makes a difference on the margins. But it's very difficult to make investments in this space. They're the best in the world, I would say. And they built a new mill in Texas. And I believe the IRR on that project is, under 20%. And they had everything going for them there. I mean, they're doing well. But when you think about that in terms of like the scale of opportunities, we really look at it as, over the history of the company, which is, I don't know at this point, 40 plus years, they've always been industry leaders, and whatever the market is thrown at them, they've been able to adapt. And that's really why we invest alongside them, because they're going to know how to operate this business way better than I ever am.
We've got a question on royalty plays. Our questioner is Adam, and he says he loves these royalty plays. He owns Freehold for oil, Franco and Wheaton for metals, saying that Wheaton and Franco, they've run up. Seems like they're just printing money. Can these two stocks keep performing given the premium price?
Well, if I had a crystal ball, I'm not involved in any of the companies he mentioned. And it's not because I don't have a huge amount of respect for what they've done. This summer, spent a little bit of time at an event with Randy Smallwood, who's, one of the founders of Wheaton, and I think just moved from CEO into more of a chairperson role. And these companies have been incredible. If I had been there when they started it, now they're just, big, well-owned. It's not what I represent to my clients.
Do you prefer like the small and mid-cap owners, operators of potential assets versus royalty companies, like as a general rule? Or
well, generally we like to say, we're looking for opportunities like hidden gems, I guess. We would like to own a business before it's a household name, and these are household names. When they started Wheaton and, nobody, Randy's like, he had to tell people what a stream was.
Yeah.
It was truly an entrepreneurial venture that could go either way. And I think these are incredibly important companies to the ecosystem of development. But I do think there's more competition. People are more shrewd. There's a lot of different ways to allocate capital. So I expect it's not maybe as easy to make deals as it was when they started. But they're going to find good opportunities. And now they're the size where good opportunities come to them. Right?
Yeah.
And so that's what I find challenging about trying to go, if you'd say, down cap in royalties, because there are some people out there, is you think to yourself, okay, well, if Wheaton or Franco didn't do the deal.
And you're doing it,
right?
How good are the economics?
And it could still be good because it just might not meet the criteria just due to size for a Wheaton. But, I think that he already is invested. He owns them, so that's great. I don't know about the immediate short-term value, but they have so much in their portfolio, like especially going into an increasing cycle of investment in the mining space. I would just think more and more of the deals they wrote in the past are now going to start making money for them. So that's a positive. And then if you switch to the energy side, he has Freehold, there's also Prairie Sky, and there's Topaz. That is where I have a bit of ownership, where we have Topaz. It was a spin out of Tourmaline, which you already know that I like. And we've maintained and grown the position because unlike maybe the materials space, energy, it's still underappreciated, I think, from a financing standpoint. And so Topaz is really a financing company, whether it's a royalty or, a purchase of infrastructure. They have a lot of levers they can pull if and when they find a partner they want to invest with. So I think that type of structure is very appealing to the energy companies because they can get financing from a group that really understands their business. And in the past, they've had some strained relationships maybe with, traditional financing from banks and others. So I like that.
That's a polite way of putting it.
I'm trying to be polite.
Banks have not wanted to finance these energy companies because of political reasons, I guess, is what it comes down to. And I love, a teachable moment. I think people still wonder, what's a streamer? What's a royalty? They basically offer financing for projects or two companies. And in exchange, they get a royalty. They get a % of the revenue that comes off of that. Let's pivot to, you said you like to look for hidden gems. We got a question on Osisko Metals. There's a lot of Osiskos out there. This is Osisko Metals. They've got the Gaspe Copper Project growing along with their Pine Point zinc mine in Northwest Territories. The question is coming from Kyle. Is it reasonable to expect them to be included in the federal government's priority list once their project is completed at the Gaspe? I feel like I have
a lot
people
there.
talking. Yes, but basically, I like this idea of like, are we picking small cap mining stocks in Canada because we think the government is going to do something?
Yeah. What is that quote? I'm from the government. I'm here to help.
Yeah.
No, I think I can't say what the government's going to pick. I would be of the view that I would rather that policy is adapted so that everybody has an opportunity to shine versus picking projects. But we do need some sentiment change. I think we need more sentiment change in energy maybe than mining. But we took a look and we couldn't find a single mine that had been permitted federally since C-69 was put in place. So it is a policy that the energy companies have really been vocal about, but it's affected every major project in Canada.
Yeah.
And that's not repealed. So, but in regards to Osisko, let's just talk about, this is a group of individuals who have created an incredible amount of value. Your listeners can go and listen to or look at their presentations. But this team, discovered and started and developed, I believe, and then brought the initial production in at Canadian Malarctic, which is one of Agnico Eagle's largest assets. They've then recently had Osisko Mining, I believe it was called, which was another Quebec gold company that they drilled out for many years and recently sold to Goldfields. And now they're doing this copper project in Gaspe, which of course copper is very topical. It's on the list of critical minerals. It's a previously producing asset. It's low grade. They're going to drill it for several years to, capture the size, what the prize is there. And they're obviously involved because they think it's very substantial and it's going to be a profitable mine. It's 3 or 4 years away, if not more, from, getting into development.
Is that too far to be interesting for you right now? Or are you interested?
I would watch it because, again, going back to people, I think that this is a great group of people.
I want to close it out by asking about Equinox Gold. We actually did have Ross Beatty on the show this summer. The question is from Sonia. Do you like Equinox Gold? It's had a great year, but is the gold rally over? When we spoke with Ross, it had not had a great year. It was as if the rally wasn't happening. And Ross was so candid about all the mistakes that they had made and then said, but it's about to change. And then literally next week, they reported results and it kind of did change. And the stock, popped from there. I don't want to take full credit for it, but, our timing was great.
You just take credit for it.
Yeah, just take credit. Our timing was great in putting it on investors' radar. And I think you own Equinox Gold.
Yeah.
Do you still like it?
Yeah, for sure. I really like it. And it is our largest position in gold, I believe, right now.
Tell me why. And was it when it was lagging or was that what made it interesting to you?
So we have quite a history. We owned Equinox and then we owned Calibre, but not Equinox. And then Equinox bought Calibre and, it was a takeover just based on the relative sizes of the companies. But it was a very unique transaction. And that is really what reset Equinox. And, it's not entirely like Equinox didn't have a lot of good things going on its own, but they've had some operations down in Mexico that have had some challenges. They were building a huge project, which is the Greenstone open pit mine here in Canada. So that's taking up a lot of management time and energy, and a portfolio of other kind of smaller producers and whatnot. And, it had been languishing, I guess. And Calibre, on the other hand, they were building a mine as well in Canada. They have operating assets in Nicaragua, which not everybody loves the jurisdiction, but they have an excellent team. And Darren Hall is the CEO, and he is really a miner. We sat down with Darren when the deal was announced and trying to understand, okay, what does this mean for Calibre? Because we were very, invested there. And it was spending time with him and hearing about how excited he was about all of the things that could be done with the assets within Equinox and also for the benefit of the Calibre shareholders. And ultimately, we increased our position and decided to stay in Equinox. And what you're going to get now here is, pretty much all of the development risk is done. They have 2 Canadian assets that this is actually kind of shocking. When they're at full production, their planned production, Equinox will be the 2nd largest gold producer in Canada.
Wow.
So Agnico Eagle is the first, and it's a fair number of ounces ahead, but that they're the 2nd is incredible. Say what you want to say about Canada, but I think it's a very desirable country to own gold assets in. They will be accruing cash flow now because the development spending is behind them. So paying down debt and deleveraging rapidly. And, your listeners know that for every dollar you reduce in debt, that's another dollar that's going to go to shareholders over time. So I think there's a lot of really good tailwinds here at Equinox. And then, the team that's there today, and it's a combination of Caliber and Equinox talent, but, the leadership, they are really focused on deploying capital into the highest return. I know that sounds kind of funny, but sometimes when you're in a tougher operating environment, you have to just deploy capital where it needs to go to keep things working, right? Well, now they have flexibility that they can actually start
be selective about it.
Strategic.
So the stock has had a nice big run. It's pulled back. You would feel comfortable adding here, continuing
it's
to
still at a lower valuation than a lot of companies. I think it's also at 0.7 times. And other companies, IM Gold, Alamos. Obviously, Agnico Eagle is quite fairly or highly valued, always has had a premium. They're well above 1 times. So just in that sort of comparison, there should be room for Equinox to come up to where their peers are.
Let's get into your pro picks, your top ideas in resources. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, you've got 3 ideas from 3 different sectors. Is there a common thread? Are they all just like small caps that you like?
Yeah, I think that the common thread, I was looking at what I picked, it's really talented Canadian management teams and near-term production growth.
Okay, let's get into your first one. Definitely not a household name. And you said you like that. You like owning stocks before they're household names. It's called Champion Iron. What's the play?
So Champion Iron, I guess a little bit of education your listeners may or may not know, but iron ore is, by orders of magnitude, the largest mined commodity on the planet. Way more tons than any of the other commodities we've talked about today. It's really a staple of life. And the big thing about iron is steel. So everything around us is built with steel. That's what iron is being used for. And why I like Champion, it's layered. We'll go into it. But here we have, about a $3 billion company that has iron production right here in Canada. And we are entering a period where they're going to be producing what's called, it's like 69%, or it's a higher grade iron ore. So they're taking about half of their current production, converting it into this pelletized feed. And for any of your listeners that might be interested in, more of a greener investment, this type of iron in electric arc furnaces, so that are going to create steel from electricity instead of coal, it's been shown to be less carbon intensive. So, it is a desirable feedstock. They blend it in or they use parts of it. And anyways, so they're going to be converting their production over and capturing a premium price above what you see in the market for iron ore. But what I want to go back like a little bit and just why do I like this company so much? So, what you're getting here is about 7 or 8 years ago, they actually bought this Bloom Lake mine out of a bankruptcy. So the previous owners had put billions of dollars into the resource and the capital infrastructure. I believe Champion Iron, the founding shareholder Michael O'Keefe and the CEO David Cataford bought these assets for under 50 million Canadian, and then quickly put them back into production and have since doubled the production at the asset. And now we're entering a period where the capital spending is behind them. So in the history of this company, they have, not ever been in a period where they're not making big capital investments. This last project here to upgrade is, I believe, 80% done. It'll be in production next year. So a real inflection period on going from spending to, accruing cash.
So the ticker on this is CIA. And I think this point that you're making is an important one, because if you look at the last 5 years, it's such a cyclical stock. It bottoms at $4, it tops at $8, and then it's rinse repeat for the last 5 years. So now it's moving up from $4 a share up to $5. My question was going to be, does it do that again? Does it go to $8 and come back down? But your point around, it being at an inflection point, I wonder if that takes it to a new part of its journey.
Yeah, well, I mean, myself and all of the shareholders that are involved, which is quite a small shareholder base, actually, because, I was speaking with the company not that long ago, and I think they could, in 4 or 5 investors, wrap their hands around 50% of the stock. So it's quite tightly held. But if you look at the assets in the company, both the producing assets and what they have as future development, you can easily make an argument that the replacement value is, double today's share price, maybe even triple, if you want to be, cute. So I do believe that, as they come into this premium production, some people might be waiting to see what's happening here. And the other thing, again, investors should be aware of is things trade on sentiment, right? So sentiment right now is like China is out of favor. A lot of the steel production's in China. A lot of this goes overseas right now. So if you want to be bearish on China, you're going to be bearish on Champion. But I just think that isn't a long-term view, because steel is needed. And having supply, especially there are still companies that are looking at the carbon intensity of what they're doing, or even just the supply chain. Where is our supply coming from? So as more electric arc furnaces come in to play in North America, this is a closer supply than a lot of the iron resources that are out there.
I'm pretty well covered for only a $3 billion market cap company. 17 analysts and 14 with a buy, just to give a sentiment on what the sell side thinks. We've got your second idea. We haven't talked about uranium this whole show, and it's because I knew it was coming up here. Denison Mines is the way you want to play uranium. What a shot out of a cannon these uranium stocks have had. Denison, though, has not reclaimed its highs in 06 and 07 the way maybe like a Cameco has gone on to make lots of highs. Talk to me about uranium. Is it a bubble? Why are you picking Denison?
Yeah, sure. So we've owned Denison, I think, since 2023, maybe a bit earlier. And
good for you. It's done well.
Again, I'm not, I just want to say the CEO there, David Cates, he is so exceptional. Every time I sit down with him, I learn something. I mean, he has built a career in uranium, and it's a very unique market. And especially on the actual marketing side, so selling the uranium, people always talk about like a spot uranium price. Spot uranium is irrelevant. I mean, most of these things are contracts. And David and his team actually, apart from like accumulating uranium mining assets, they've also been very good allocators of capital in the uranium market. They managed a company which is now basically the Sprott Uranium Trust, so very astute in how to buy and sell physical uranium, which will benefit them as their mine comes into production. So what do I like about uranium? Just starting there, we invest in everything in resources, and I believe that for a growing and improving quality of life, we need all of the resources, fossil fuels and renewables and, whatever else we end up discovering and capturing over time. But uranium, as far as like a green baseload electricity, it just can't be ignored. And I think there's 70 nuclear reactors globally, like under development right now. So just that will increase the, demand for uranium by about 20% in the coming years. And Canada is like the second largest endowment of uranium in the world. And I would argue the only jurisdiction that has values that are aligned with a lot of the countries that are now looking to, bring nuclear reactors, and whether those, be small nuclear or whatever they decide to pursue into production. I think they're going to want supplies from countries like Canada.
And does that mean we move, like, what does that do to the supply-demand dynamic? Like, how scarce is this resource based on the demand projections?
So again, I'm not the macro expert on it, but if you go to any of these uranium exploration or development companies, you can get the chart from them. I think that there is a very near-term, delta between supply and demand. But if we go out 5 or 10 years, it's quite large. And that's why, people are getting very excited about bringing on new uranium mines. Of course, these are long capital projects. Things are going to change in between. But, whether they're 25 or 30% wrong, they're still in the right direction. There's a gap.
Your third pick is Paramount Resources, natural gas.
Yes.
And this one cut its distribution this year. Talk to us about maybe some of the challenges it faced this year and why now is a good entry.
So Paramount is something that, we at Deans Knight have owned since the late 90s, either equity or credit or both. They have been around since 1978. It was founded by Clay Riddell, and his son Jim runs it now. And I've always liked Paramount, and I feel like Paramount's always been a little bit misunderstood. Speaking about the distribution cut, so what happened here with Paramount, which is a really good example of what they've done over the years, but they have a process, and I don't know how Jim says it, I may be misquoting him, but they're trying to get low-cost capture, so grab, land and opportunities, then delineate it, so drill it out, prove it up, develop it, and then harvest it, whether that means keeping it for cash flow or selling it. So what happened at the end of last year and then closed early this year is they sold about, I think, 3/4 of their production to Ovintiv for what was, Ovintiv is a US company, for what was about 80% of their then enterprise value. So a little over $3 billion. They distributed $2 billion of it through a special dividend, and then retained a billion or $1.2 billion to grow the company from there. So they cut the dividend when their production dropped by, 60%.
Because they didn't have those assets anymore.
Right.
So it wasn't like a strange dividend cut.
No. And then what I think is so exciting about Paramount is, they're growing now, from the close of the transaction for the next few years at over 20% a year or somewhere around there. I mean, no one's growing in Canada. We went back and asked about the junior, if I'm a resource investor, like, yes, I want some steady eddy, kind of the Tourmalines or ARCs of the world, but I want growth. Like that's what my shareholders are looking for as well. And Paramount provides that. And it's totally funded. There's not going to be any dilution, and they're taking, they're going to maybe have around 30,000 production when they close the deal, 30,000 BOE a day. They're on the path to, I think they have projects commissioned up to 60 by the end of next year. And then if they make an investment decision, which I believe is getting close on their Montney asset, and I'm not sure how many people you've interviewed in energy, but the Montney is a pretty desirable asset right now. Theirs is called Sinclair. That would take the company to 120,000 BOE a day. So from 30 to 120 and, within 5 years' time, no foreseeable dilution. I just think it's an excellent outcome.
Stock's up 40% so far this year. It's outperformed, maybe peers like Tourmaline and ARC Resources. Do you continue to see those kind of gains in Paramount, and how does it stack up against some of the other nat gas peers? Like, how preferred is it relative to the others?
Well, I don't know how preferred it is on the street, but by me.
That's what I mean. Yeah. Like, who's your favorite child? Who's your favorite child?
I mean, I like the growth, and I like that it's funded growth. We don't have to go back to the market. The Riddell family here is like the majority shareholder. So, they have become incredibly wealthy off of this company. And I would like that to happen for my shareholders as well. And I think they're better positioned than ever. It's been misunderstood because sometimes assets, and I don't think it's a huge amount of dollars, but, they are tied up in land. Like some of the things they're developing today were in their presentation 10 years ago was like down here opportunities. And the market doesn't always see that long term. Shares turn over so quickly, and a lot of shareholders don't have the same objectives as like myself or obviously the Riddell family for holding something for the long term. And I will say, it's very liquids rich. So even though, yes, it's natural gas, they're producing oil as well. So you get a mix of those commodities. But yeah, I just think it's been a bit underfollowed, underloved. And yes, I'm happy about the share performance to date. But, if they develop on the plan that they're saying they should, then they'll have a lot more cash flow in the future. And that should accrue to the shareholders.
Kelsey, it has been so great to speak with you. A lot of under the radar names and insights. And I think it's going to serve our viewers. Thank you so much for joining me.
Thank you for having me. It was such a pleasure.
This is your ETF Minute, and today we're talking about the Middlefield Healthcare Dividend ETF. The ticker is MHCD, and to do that, we've got the fund manager behind it, Rob Moffat of Middlefield. Hi, Rob.
Hi, thanks for having me back.
Thanks so much for joining us. We're going to talk about what's going on with the healthcare sector right now, but first, let's talk about the role healthcare plays in your portfolio. I think of it as a kind of a defensive part of the portfolio.
For sure. I think healthcare offers a good mix of both defense and growth. And the great part about being an active manager is that you can lean into either one of those sides depending on the prevailing market conditions. I think one of the first and foremost things to highlight right now is demographics. It's something that we've been talking about for a really long time, but the moment where demographics are actually going to have an impact on demand has finally arrived. Baby boomers are starting to turn 80 next year in 2026. And that's important because obviously seniors spend a lot more money on healthcare products and services. So we think there's some great demand tailwinds for healthcare over the next decade or so.
And I feel people have been talking, to your point, about how demographics are so favorable to the healthcare sector, but there's nuance, right? And we see that in today's market conditions where the healthcare stocks are not the star performers. And there's kind of an assault. Healthcare is such a huge basket, right? There's pharmaceuticals, there's health insurers, and there's an assault taking place in those different areas.
Yeah, that's correct. So the healthcare sector has certainly lagged this year. And up until a few weeks ago, it was at basically the biggest relative valuation discount that we've seen in 30 years. So a very steep discount that the sector's been trading at. And we're finally starting to see some green shoots emerge that these policy overhangs, and specifically tariffs, MFN drug pricing, stuff coming out of the RFK Jr., they're finally starting to show that they have a lot more bark than bite. And really the fundamental backdrop hasn't really changed much at all. So we're still very constructive on the earnings power of these companies. And we do think that we're in the early stages of a sustained re-rating where sentiment is starting to improve.
Now, when you talk about a big valuation gap like that, I'm sure it's painful if you're owning some of the stocks to the downside, but does that get you excited about increasing exposure at this time?
It does. And in fact, over the last few weeks and months, we've really been getting more aggressive and buying some of these deeply discounted names that we hadn't really owned for quite a long time, but the valuations just got to a point where it seemed like you had to own them. And even if a lot of these names get back to, say, their average historical multiples, there's still 20 to 30% upside in a lot of these names, just for getting back to what we think is a reasonable level to trade at. So definitely excited, have been aggressive. We're fully invested and quite bullish right now on a lot of the names in our portfolio.
And I guess you hit on a key point that it's a really actively managed fund. You're not an index fund tracking the healthcare sector. You go in, you go out when it's appropriate.
Correct. So I think this sector, maybe more than any other sector, it's really important to be active and to be on top of things. There are times when you want to avoid certain sectors. For example, pharmaceuticals has been an area that you didn't want to have too much exposure to over the last 6 months, and we were underweight. But more recently, we've been adding back to that area. Another area that we've been adding to that we're really constructive on going forward is biotech. Biotech historically performs very well when the Fed is in a rate cutting cycle. There's a lot of patent cliffs that big pharma companies need to backfill, and there's probably going to be a wave of M&A. So, that's an area that we've been adding to in a more tactical manner.
The name in the ETF has the word dividend. So let's talk about how you layer that onto your strategies.
Yeah. So the core of the portfolio is established and mature high quality dividend paying companies. Over 80% of the stocks in the portfolio do pay a dividend. And that lends itself to a very, stable, low volatility profile in the portfolio. And these are really high quality companies that have been around for a very long time. And as a result, they have very predictable and stable earnings, and they pay a high level of growing dividends as well. So the ETF has over a 5% distribution yield, which I think is a really attractive feature.
Rob, thank you so much for joining us. And for more information on this ETF, ticker MHCD on the TSX, you can go to middlefield.com or click the link in the show notes. Okay, so coming up on the next show, we've got Jay Hatfield of Infrastructure Capital Management. We're going to talk about the Trump trade. And I'm not talking about the markets. I'm talking literally the companies that the U.S. markets are buying. Should you be buying too? If you've got any questions, remember what to do. You got to email us questions@inthemoneypod.com, and we'll catch you on the next episode.